of coming back to the meeting room to check who is raising hand and who is not raising hand. So please, if you have any question, you can just unmute yourself and call my attention, please. I may not have the luxury of coming back to the meeting room to check if someone is raising hand to ask questions or not. So if you have any question, unmute yourself and ask your question. Good evening, everyone. Once again, welcome to Strategic Business Reporting First Class, where we will be discussing the first topic, fellow subsidiary. What is fellow subsidiary all about? When we say something is fellow, or when we say someone is a fellow, it means like they are peers, they are the same, they are under the same heading. They are under the same heading. So when we say fellow subsidiary, it is just preparing consolidated account for more than one subsidiary. At skills level, the consolidation we learned was basically one subsidiary, one parent. At most, what we did at skills level will be one subsidiary, one parent, and one associate. But here, we want to look at where an entity has more than one subsidiary, maybe two, three, and so on. How do we consolidate it? Believe me, the consolidation rule is still the same as we know under consolidation of one subsidiary. The only thing here The only thing here is that the only thing here is that what's it called? The only thing here is that as you are doing whatever you do for subsidiary A, you do for subsidiary B, you do for subsidiary C, depending on the number of subsidiaries they have, as it affects each of them. What do I mean? If I want to consolidate now, I understand that I need to draw the group structure. Yes, the group structure will encompass every one of them. So the group structure I'm drawing, ideally when we were doing let's assume I want to draw the group structure now. I would say A, which is the parent, acquires B. This is a single subsidiary group structure. But if it is a fellow subsidiary group structure, then we will have something like A having an interest in B, also has an interest in C. And if they have more than that, I can still draw it out here and say they also have an interest in D. This would be a fellow subsidiary group structure where the parent has interest in more than one subsidiary. And the next thing is also that if I want to do the next thing and I want to calculate my net asset summary, the net asset summary, I will be calculating net asset summary of all of the subsidiaries. So I'll calculate for B separate, I'll calculate for C separate, and I'll calculate for D separate. If I want to calculate goodwill, I will do for each of the subsidiary also, B, C, and D. If I want to calculate consolidated retained earnings, because consolidated retained earnings is for the parent, I will not need to calculate for each subsidiary. But if I want to calculate NCI, yes, I'll calculate NCI for B, C, D. And when I'm consolidating the result of all of them together. But yes, I'm consolidating the result of all of them together. So it will be, if I want to consolidate PPE now, I'll say PPE of A, which is the parent, plus PPE of B, which is the subsidiary 1, plus PPE of C, which is subsidiary 2, plus PPE of D, which is subsidiary 3. Do we understand? Do we understand?
Yes, sir.
Okay, good. So having understood that, in order to just refresh our memory before I pick a question to solve, I just want to remind us of how we go about all of these things. So when we are calculating net asset summary, remember that our net asset summary is for us to calculate what is the net asset of the subsidiary at the date of acquisition and at the date of consolidation. And the essence of doing this is to know what has been earned in post-acquisition period, which is meant for both the parent and the subsidiary, and will be shared according to their percentage of holding. You know, before acquisition, the whatever the subsidiary makes is for the subsidiary alone. But since acquisition, whatever the subsidiary makes is for the parent and the non-controlling interest in the subsidiary. And you know, just like when you are doing a business on your own now, when you are doing a business alone, you might not even keep proper books of accounts. You may not even be interested in how much the business make on a daily basis or how much the profit for the year is. But the moment, but the moment your friend add money to the business or become a part of the business, maybe as a shareholder or something, then keeping proper records becomes necessary. Keeping proper records become necessary because you will not want your friend to cheat you. You also don't want to cheat your friend. So you have to start keeping proper record so you can know how much the business actually makes from when your friend joined to whenever you want to share profit, so that that is what will be shared. You will not want to share the profit you have made before your friend join the business. So that's the essence of net asset summary. And how do we prepare the net asset summary? From accounting equation, we understand that assets equals to capital plus liability. Asset equals to capital plus liability. Asset equals to capital plus what? Plus liability. Now, when we say asset equals to capital plus liability, you know, whatever we have said that what the relationship that exists between the parent and the non-control and the subsidiary is that the parent acquires equity interest in the subsidiary. But we understand that whatever equity interest the parent is acquiring is actually to acquire the assets of the subsidiary. But you know, whatever equity the subsidiary has, whatever capital we have in a business, the whole essence or the aim of the this thing is is um is to buy assets, maybe buy PPE or have cash flow to run the business, amongst other things. Now, when we now want to calculate net asset of the business, because what we should actually be claiming that we have should be the net asset of the business. But because the asset and liability might be too voluminous, in calculating net asset summary, we use the equity of the subsidiary. We use the equity of the subsidiary. So in calculating net asset summary, we usually have three columns. One DOA, the second one DOC, the last one PAE. DOA, which is abbreviation for date of acquisition, DOC, which is abbreviation for date of consolidation, and PAE, which is abbreviation for date post acquisition earnings. Post acquisition earnings. Now, what do? We bring the ordinary share capital because those are the equity items. So whatever the ordinary share capital value is at the date of acquisition, we'll bring it here. Whatever it is at the date of consolidation, we'll bring it here. Then the difference between the date of acquisition and date of consolidation, we bring it to our post acquisition retained earnings or post-acquisition earnings. But we don't usually have difference in our ordinary share capital. We don't usually have difference in our ordinary share capital. So share premium, if we have it, we also bring it. We also bring it, the difference, we bring it here. Then retained earnings. Retained earnings at the date of acquisition, at the date of consolidation, and if we have any other group adjustment, maybe a fair value adjustment, either a surplus or deficit, we bring them also. And once we do all of that, we take summation of this. It gives us the net asset at the date of acquisition. We take summation of this. It gives us net asset at the date of consolidation. And we take summation of this. It gives us the post-acquisition earnings. And it is this post-acquisition earnings we will now share between parent and non-controlling interest. While parent share will be added to parent consolidated retained earnings, NCI share will be added to the value of NCI at the date of consolidation. Does it make sense? Do we understand? Hello, does it make sense? Do we understand?
Yes, sir. Hello, sir.
I can hear you. I can hear you.
Can you go over it again, please?
Okay. Please, just like I said earlier, I will not be frequenting the meeting room to check charts, reactions, and the likes. So please, if you have any information from me, I would prefer you unmute yourself and speak to me. And also, when I ask if we understand or not, please let's try and respond, because that's how I would know that we are still in the meeting. And if for any reason you just see that I leave the call, you can't hear me, I've left the call, please try and place a call across to me, because I may not even know that I'm out of the meeting and I'll just keep explaining and talking.
Noted.
Thank you very much. Now, I take it again. You see, in group account follows a sequence of calculation. Now, like I said, the first thing is to draw the group structure. Though, what I've drawn here as the group structure is not.
Are you there?
Sorry, what I've done here is not complete of the group structure, because in the group structure, we'll show the percentage the parents hold in the subsidiary. Let's assume they hold 60%. Then I'll show what is the NCI, 40%. Then I will show what is the date they acquire the subsidiary and what is the date we are consolidating. So let's say they acquire subsidiary 1 January 2022, and we are consolidating as at 31 December 2025. Now, the essence of all of this is for us to aid us when we are preparing what's it called? Is to aid us when we are preparing when we go to our calculation, so that we will not be looking for what is not lost again. And let me take it from there. To calculate the percentage of holding, if you are not given, percentage of holding will just be percentage of holding, that is the percentage the parent has in the subsidiary, will be the number of shares acquired divided by number of shares in the subsidiary, Some question might take us to that regard, that will require us to calculate this thing. So having said that, now NCI will just be 100 minus percentage of holding. That's NCI. 100 minus, because if in a business we have 100% shares, one person has acquired 60%, automatically the 40% will be for those that doesn't have control. And that's why we just classify all of them as non-controlling interest. So that is for that. That is for that. Now the next thing is in calculating net asset summary. I've said that the net asset summary is basically calculated for us to determine the post acquisition earnings of the subsidiary. Why do we need to calculate post acquisition earnings of the subsidiary? It is because the parent will only enjoy the post acquisition earnings of the subsidiary. If I decide to buy MTN shares today, believe me, the price at which I'll buy today is different from the price at which somebody bought yesterday or somebody bought at the beginning of the year. Reason being that whoever is selling today would have factored in whatever profit or they feel like, or whatever the market reflect that MTN has made up till now, because they know if I buy it today, by the time they want to pay dividend, I will be the one they will be paying, and I wasn't the one that invested my money for January to July. Why should I get the full year dividend? So they would have collected that money they feel like they will get in the place of dividend from me when I'm buying, then I'll get my money back from the dividend when they pay. So the same thing, if we want to buy what's it called, if you buy when you buy your shares in the subsidiary, you will only be sharing whatever profit the subsidiary makes after the acquisition of the subsidiary. And to know what the subsidiary makes after acquisition, especially because what we are preparing is consolidated statement of financial position, we want to know, since we acquire it till now, what have they made? That's what we'll be sharing. Everything is what we'll be sharing. So in order to achieve that, what do? We prepare the net asset summary. The net asset summary will have 3 columns, or let me say 4 columns. One column to show the details, another column for the values at the date of acquisition, another column to show the values at the date of consolidation, and another column to show the values of post-acquisition earnings. And I say the values of post-acquisition earnings is more like the difference between the date of consolidation figures and the date of acquisition figures. Now, even though we have called it net assets should actually be what? Asset minus liabilities. But because asset and liabilities information can be very much, it can be so much that it will be difficult for us to now be listing it out each and
Hello.
listing it out. Now I can hear you. Now the next thing will now be what? The next thing will be that instead of we now listing all of our assets and liabilities, we just use what? We use what is it called? We use the equity instead of assets and liabilities. Don't forget, from accounting equation, assets minus liability is equals to capital, and capital is the same thing as what? Equity. So instead of using assets and liabilities, we'll just use equity. And equity items are things like what? Ordinary share capital. So for the ordinary share capital, we bring what value is it at the date of acquisition, and what value is it at the date of consolidation. For share premium, we bring what value is it at the date of acquisition, and what value is it at the date of consolidation. For retained earnings, we also bring the value it is at the date of acquisition and the value it is at the date of consolidation. And I said if we have other group adjustments like fair value surplus, under depreciation, unrealized profits, we bring them as they affect what? As they affect the equity. We bring all of them. And once we bring them here, we get a summation of it. The summation of the DOA column gives us the net asset of the subsidiary at the date of acquisition, while the summation at the date of consolidation gives us what? The net asset at the date of consolidation. Of it, these two are very important. We need the net asset at the DOA when we are calculating goodwill. We need the post-acquisition earnings to know what we are sharing, because the essence of the post-acquisition earnings is now to share it between what? Parent and non-controlling interest. And I say parent share will be added to their consolidated retained earnings, while non-controlling interest share will be added to the NCI value at the end of the year. Do we understand?
Yes.
Moving on, I would go
Yes,
to
sir.
goodwill. Goodwill, in calculating goodwill, we have said it is the excess of identifiable net assets over excess of purchase consideration over identifiable net assets. So if that is goodwill, then how do we calculate it? In calculating goodwill, we know that the purchase consideration of a subsidiary would have come from two sources. What are the two sources? Number one, what the parent paid to buy the controlling interest, and two, the value of the NCI shares. What the parents paid to buy the what? To buy the controlling interest in the subsidiary, and what the value of the NCI shares is, because NCI is not just buying theirs, so we value their own. So how do we now calculate the purchase consideration of the parent? Actually, in calculating purchase consideration of the parent, we have four methods in calculating it. Or let me say we have four modes of purchase consideration. We have the cash, we have the share exchange, we have the deferred consideration, and we have the contingent deferred consideration. Have we heard of all of this before? Are we familiar with it?
I think
Is there anyone
I'm
that is
familiar
not
with three.
familiar with it? Huh?
I'm familiar with three. I'm actually familiar with three,
You are familiar
which
with it. So
yes,
which one is it
cash,
that you are not familiar with?
the contingent deferred consideration.
Different. Okay. Yeah, I agree with you on that, because we don't really treat contingent deferred consideration. We don't really treat it in at skills level. But now we started treating it because so examiner has started testing contingent deferred consideration. So that is that. Okay. Is there any other person that is not familiar with any of the other consideration?
Yes, sir.
Which consideration is it that you are not familiar with?
The differ and this last one you mentioned, the contingent, the last two you mentioned.
Okay.
Yes, sir. Please come again with them.
Okay. So if you are not familiar with deferred consideration and contingent deferred consideration, I'll just do a quick recap on it. So I'll just do a quick recap on everything actually. When we say cash consideration is where the parent is actually paying immediately by cash. When we say cash, not necessarily banknotes, maybe via transfer or hold. They are paying immediately for the shares they are buying in the subsidiary. So in most cases, when cash consideration is to be used, they will tell you they've recorded it, because cash consideration is easy to record. The double entry for cash consideration would have just been what? Debit investment in subsidiary and credit cash, because cash is given. So you credit cash and you debit investment in the subsidiary, being the what? Being the asset you use the cash to buy. Being the asset you use the cash to buy. So, but the whole essence of our consolidation now is that we don't want to show this investment in subsidiary as an asset. We now want to show the entire company we bought as a result of that cash spending. That's the whole essence of consolidation. But we'll come back to that. The next one is share exchange. Share exchange is where where the parent is selling their own shares to finance the acquisition of the subsidiary. Share exchange is where the parent is selling their own shares to pay for the acquisition of the subsidiary. And in most cases, you see them express it as a percentage of the subsidiary shares. Can tell you 4 new shares for every 10 shares acquired in the subsidiary. Or they can say 1 new share for every 3 shares acquired in the subsidiary, amongst others. So if that is the case, in share exchange, the double entry will still be debit investment in subsidiary. But having debited investment in subsidiary being the asset you bought, you credit ordinary share capital of the parent with whatever value the share capital you got from the shares you are selling, and credit share premium account with whatever premium, whatever excess over the share nominal value you get from the acquisition. That is for purchase. That is for share exchange as purchase consideration. Deferred consideration is where you want to buy the subsidiary today, but you want to pay at a future date, even if it is tomorrow. You know, in finance, we have said that time value of money. A naira today is not the same thing as a naira tomorrow. So the moment you are not paying immediately for the shares, we refer to it as deferred consideration. And we believe that we understand that whatever price you are now paying, whatever price you are paying for a deferred consideration would have taken cognizance of interest or other macroeconomic variables that will affect the time value of money. What do I mean? If you want to buy these shares today, you are paying 50 naira. But because you said it will take 1 year before you pay, you can say, okay, you will have to pay 55 naira. That 5 naira you are paying in excess of it, in excess, is actually as a result of you not paying immediately. But for accounting purpose, we will say that that 5 naira is a finance cost. It cannot be part of the cost of our investment. So what do we do? In calculating deferred consideration, we usually have our deferred consideration calculated as A into bracket 1 plus R raised to power minus N, where A is the future value of the consideration. That is the amount you want to pay in future. If the future value of the amount you want to pay in future is what our A is. Our R is the interest rate. And the interest rate is usually the parent entity cost of capital. The parent entity what? Cost of capital. Then the next one is what? N. N is the period in which you want to use to pay. Period. So if it will take you 1 year, it will be -1. If it will take you 2 years, it will be -2. If it will take you 4 years, it will be -4, amongst other things. Is it clear? Is it clear?
Yes.
Yes, sir.
Yes, yes, sir.
Yeah. So once we calculate it like that, whatever we get with this formula is what we will now debit to our investment in subsidiary, and we'll credit it to where? We'll credit it to deferred consideration account, deferred consideration account, as a liability. Now, because we have discounted the value to today's term, and every year at the end of each year we will now be calculating what amount of interest should have accrued on this outstanding. We call that discounting, discount unwound, discount unwound. And calculating discount unwound is very simple. It's just the interest rate, which is the cost of capital, multiplied by the deferred consideration figure. That is the present value of the deferred consideration you got using this. Or if it is subsequent year, you now use that, you multiply by the balance of the deferred consideration. Once you get that, this interest amount you get now, whatever you get, you debit that to your finance cost in your SOPL. So where we are not consolidating SOPL, you just debit it to your consolidated retained earnings. You debit it to consolidated retained earnings, because anything going to SOPL, the end result of it is to what? Is to go into our retained earnings. And because this is an expense, it will be debited to our consolidated retained earnings to reduce our expense. Then we will now credit it to where? We'll credit it to the deferred consideration liability account, so that it will keep increasing our deferred consideration. And by the time we are due to pay, what is in our deferred consideration account would have equal what we want to pay. Then we can just nil it off by paying and debiting deferred consideration, then crediting cash or bank, depending on how we pay. Does it make sense? Does it make sense?
Can you please repeat that?
Yes.
Can I please what?
Repeat. Just come again on it.
Okay. I said once we calculate the present value of the deferred consideration, that present value we calculate using the formula a into bracket 1 plus r minus a raised to power minus n. That value is what we will debit into our investment in subsidiary and credit in deferred consideration. But don't forget, that only represents the present value of the consideration, which is what we take to be our purchase consideration. Now, as the year progresses, at the end of year one now, the value of our outstanding as a result of that deferred consideration will change. Why? Because when we recognize it initially, we did not recognize the interest element on it. So that interest element we did not recognize. Now that the interest has become due, why didn't we recognize it at the initial stage? It is not yet due. It is not yet due. Now that it has become due, to recognize it, we'll then calculate the interest by doing interest rate times deferred consideration amount. And I say we call that unwinding of discount. We call it discount unwound. Then the double entry for that discount unwound will now be to debit our finance cost if we are consolidating SOPL. If we are not consolidating SOPL, then we'll debit what? We'll debit consolidated retained earnings. Then we will then credit what? Deferred consideration. We'll credit deferred consideration. So as we are crediting it to deferred consideration, the deferred consideration will continue to get high till it gets to the amount we are supposed to pay, when the date we are supposed to pay reaches. Then when we now make the payment, the double entry will be simple. It will just be what? Now debit the deferred consideration because you settled it, and credit the bank or cash that what? That paid the money. Is it clear?
Yes. Yes.
The last one, contingent deferred consideration. Contingent deferred consideration is where we want to buy the subsidiary shares, or we have bought the subsidiary shares. But instead of us paying now immediately, we say, okay, we'll pay you 30% of the profit in 2 years' time. or will pay you based on the share price in 5 years' time, or will pay you um, or will pay you 10% of the net asset or 10% of the market capitalization rate. So far, what we are basing the payment on is not something within the management control. It's not something within the management control. Then we call it what? A contingent deferred consideration. We want to pay in the future, but the payment or whatever payment we want to make is depending on another thing or another factor occurring. If that factor occurs, good. If it doesn't, then we will not pay. So now, what do we do when we have contingent deferred consideration? We will fair value what we will likely pay in that 5 years time, or in that 3 years time, or in any period. We will fair value it as of today. And that fair value on the date of acquisition is what will be the purchase consideration. That is what we will debit to our investment in subsidiary and credit in contingent deferred consideration account. Now, every year we will now be doing fair valuation of that contingent deferred consideration. If the fair valuation increases, we debit the difference to where? We debit it to consolidated retained earnings or finance cost, as the case may be, and we credit it to where? To the deferred consideration account or the contingent deferred consideration account. But if it reduces, then we debit it to contingent deferred consideration account and credit it to where? Consolidated retained earnings or other income. Yeah, that is on contingent deferred consideration. Does it make sense? Does it make sense?
Yes, sir.
Yes.
Yes, sir.
Yes, sir.
Yes.
Thank you, sir.
Okay. All of that was just to explain purchase consideration, which is one of the variables we use in calculating goodwill. So I come back to my goodwill. When we look at purchase consideration, we bring NCI value. NCI value. Now, this NCI value, we do it in two ways. It's either we value NCI using proportionate share, or we do it at fair value. What's the difference between the two? Proportionate share is where we are using the book value of the net asset to value the NCI. We are using the book value, that is whatever we have in our books is what we want to use to value NCI. And how do we do that? This net asset at the date of acquisition we calculated here, we'll multiply it by the percentage this NCI is holding. Like we said in this example, we are saying NCI is holding 40%. So if they are holding 40%, and this figure is, let's say, is 2,200, 40% of 2,200 is what will be NCI value at acquisition. Proportionate here. That's proportionate share method. But if it is fair value, then we'll look at what is the market value of each share the NCI hold. Once we get the market value, we use it to multiply the number of shares the NCI hold, and that will be the value of NCI. Once we get the value of NCI, we less what? We less the fair value of the net asset. We less the fair value of the net assets. So once we less fair value of net assets from this, once we less fair value of net assets from this, we now have the right amount. And if there is any impairment, I believe we've heard of impairment before, right? Have we heard of impairment before?
Yes,
Yes.
sir.
Yeah. So if we have any impairment of assets, impairment of goodwill, which is the drop down in the value of the this thing, we take out the impairment. You know, under IS 36, when we are to allocate impairment between a CGU, we first write off goodwill. It's after goodwill, we now start looking at other things. So that's also the role at play here. If the subsidiary value has dropped, I mean in terms of valuation and the likes, the share price will drop. And once the share price drops, um, it affects the business. So the impairment, whatever impairment we have, we take it out from goodwill. After taking it out from goodwill, we get the goodwill at the date of consolidation, and that is that. So we then proceed to calculate NCI. How do we calculate NCI? We look at what is the value of NCI at acquisition. Value at acquisition. So then we bring the share of post-acquisition profit. That profit we shared with we have here. So share of profit, we calculate it, which is the percentage they hold multiplied by the post-acquisition earnings here. And having done that, we have impairment. Impairment will only be allocated to NCI if fair NCI value was measured as fair value. If NCI is measured at is not measured as fair value. So far it is not measured as fair value, NCI cannot share impairment. And that is because when NCI is measured as fair value, NCI contributes to the goodwill. But where NCI is not but if NCI is measured as proportionate share, it doesn't have goodwill, so it cannot share impairment. So once we do all of that, we sum it up and we've gotten our NCI value. Then we now proceed to consolidated retained earnings. In our consolidated retained earnings, we bring the value. Consolidated retained earnings, what's it called? Sorry. We have what? We say parent retained earnings, whatever the parent has as their own retained earnings, then we bring their share of post-acquisition earnings. That is the one they shared from the subsidiary. Then if there is any other adjustment like the discount unwound, amongst other things, we do all of that and we get our consolidated retained earnings, and that will be that. Do we understand? Do we understand?
Yes, sir.
Yes, sir. Yes,
Yes,
sir.
yes, yes, yes.
Yes.
Okay, thank you very much for that. So that is just like a brief introduction to calculating what's it called? To consolidating statement of financial position for fellow subsidiaries. So ladies and gentlemen, let's take our time to go to question 3 in the material sent to us. By 9 o'clock on the dot, you can stand up straight and do all of that, but please don't sleep. By 9 o'clock on the dot, we'll start attempting this question 3. Thank you very much.
How did you say 9 o'clock? 10 o'clock. It's to
Sorry,
10.
by 10 o'clock on the dot.
10 o'clock. Oh, yeah, go and stress. Drink water.
I hope we are not sleeping here too. It's 10:01. Please, can someone read the question for us? Hello?
Yeah, yes, sir.
Yeah, with you.
Yeah, with you, sir.
Okay, can someone read the question for us? No time to check time. Even the time we use in checking time is waste of time. Well, since there is no one to read the question, I'll take it myself. The statement of financial position as at 31 December 2019 is as follows. We have that of Abba, Suka, and Zara. We have the statement of profit or loss for the year ended 31 December 2019. Abba, Suka, Zara. Assuming all figures are correct, as well as the statement of changes in equity for the year ended 31 December 2019, I move straight to the additional information. We're told that Abba owns 80% of Suka's shares. These were purchased in 2016 for 20.5 million cash when the balance on Suka's retained earnings stood at 7 million. We have to be taking note of all of these points. If Abba owns 80% of Suka's shares, that makes what? Suka Abba's subsidiary. It makes Suka Abba's subsidiary. And if they own 80% of the shares, that means NCI only has what? 20%.
20%.
The date of acquisition is what year? 2016, because that was when they acquired 80% shares in that entity. And they bought it for how much? 20.5 million cash. 20.5 million cash. If they bought it for 20.5 million cash, if they bought it for 20.5 million cash, it simply shows that what? Simply shows that it simply means that cash consideration was used in this acquisition. And they gave us that the retained earnings stood at 7 million. If the retained earnings stood at 7 million, it simply means at the date of acquisition, our retained earnings is 7 million.
7 million.
Those are the important points there. They told us that in 2014, Abba purchased 60% of Zara shares by issue of shares with a nominal value of 6.5 million. What does that mean? In 2014, that's the date of acquisition for Zara. They purchased 60% percentage of holding. Abba owns 60% in Zara. So that makes Suka and Zara to be fellow subsidiaries of what? Of Abba. Now, they said what? They said they acquire their interest in Zara by issuing shares that has a nominal value. By nominal value, we mean what? By nominal value, we mean that is the, what is it called? By nominal value, it means, sorry, let me use pen. 80% purchased in 2016 for 20.5 million cash, retained earnings at 7 million. So this one, 2014, purchase of 60 million shares, they paid by issue of shares with nominal value of 6.5 million. And you know what we call nominal value of shares? What we call nominal value of shares? What we call nominal value of shares is the intrinsic value. That's what we take to our ordinary share capital account. They now said the shares were issued at a premium of 6.5. That means what they actually made from the sale of the shares that they use in acquiring Abba is 13 million. 6.5 from the nominal value, 6.5 from the premium. That's a total of 13 million. And they told us at that date, at the date of acquisition, Zara retained earnings stood at what? 3 million. Their retained earnings at the date of acquisition is 3 million. And they said they had a fair value of net asset of 24 million. They have fair value of net assets of 25 million. Fair value of net assets. They now said it was agreed that any undervaluation of the net asset should be attributed to the land. What do they mean by this statement? Any undervaluation of net assets should be attributed to the land. Simply means that if we do our own net asset somewhere, the net asset at the date of acquisition will not give us 24 million, which is what they said is the fair value of the net asset on that day. So what do we then do? We would what? We would take whatever difference we have to be a fair value adjustment to the land. We take whatever difference we have to be a fair value difference to the land. We'll come back to that. They said the land was still held as at 31 December 2019, meaning that fair valuation we have, it is still what? It is not yet realized. It is not yet realized. Had it been the land has been sold, then it becomes realized. We'll look at it again when we get into the question. They now told us that included in the inventory of Zara and Zuka as at the year end are goods they purchased from Abba for 5.2 and 3.9 million respectively. Now, because we are doing consolidation of statement of profit or loss, whatever goods that is being sold within the group will be derecognized, because it's just like in preparing group account, we are seeing all of these entities, we are seeing them as one. Now, how can we say one entity is selling goods to itself? It is not possible. It is not, doesn't make any sense. So whatever they have sold to each other, we cancel it out. Then they now said Abba aims to earn a 30% profit on cost. Abba aims to earn a 30% profit on cost. Now, the total sales from Abba to Zara and to Zuka were what? Were this. Okay. I think I've mixed the figure up. The figure we have here, 5.2 and 3.9, is what they have left in their inventory. Is what they have left in their inventory. But what they actually sold to them during the year is 8 million and 6 million respectively. The 8 million and 6 million would recognize it from the statement of profit or loss. But that 5.2 million and 3.9 million will work on it in the statement of financial position. So what I think is we may not just leave only into and do it. I'm still trying to get someone, if I can get someone to pair with him, someone that has experience. Okay, having done that, we were told that Abba and Suka proposed dividend at the end of the year of 2 million and 2.5 million respectively. No accounting entries has been made for this. We should not make any accounting entries for this. Why? IAS 10 event after reporting period specifically stated that what? There should be no accounting treatment for proposed dividend. If a dividend is still proposed, we are not recognizing it in our books. If it has been declared here or yet to be paid, we will recognize that. But proposed dividend, no, we don't record it. So that information is just making noise in the question. They told us that Abba carried out impairment tests in accordance with IFRS 3 and IAS 36. Then the recoverable amount of goodwill at the end of the year was 5 million. At the end of 2016, it was 5 million. At the end of 2019, it was 4.5 million. What does this mean? It means that goodwill has been what? Impaired twice between the date of acquisition and the date of consolidation. Now, what did they ask us to do? They asked us to consolidate the statement of profit or loss. They asked us to consolidate the statement of financial position, and we should make an explanation. That explanation, we'll leave that for now. Let's go to our consolidation. How do we go about consolidating? We have said that what? The first thing we have to do is to draw group structure. Any question before I proceed? In our group structure, we have ABBA, who acquired who. By looking at this information we have here, who they acquired first is Zara, because they acquired Zara in 2014. And what did they acquire there? 60%. And that makes NCI to be what? 40%. Then they also acquired who? Suka. They acquired Suka. How many percent? 80%. NCI 20%. It doesn't matter how you arrange it. If you put Suka here and you put Zara here, it's not an issue. Just don't mix up their information. The date of acquisition of Zara is 2014. The date of acquisition of Suka is 2016. The date of consolidation is 31 December 2019. Any question at this point? Any question at this point?
No,
For
sir.
me, no
No,
question.
no question, sir.
Okay. So what we do is we'll take each and every additional information if there is need for us to do workings on it. For note one,
Sir,
we
sorry.
don't have any.
Sir, I have a question.
I'm with you. Go on.
Sorry, sir. So that DOC, is it date of completion
Date
or
of
date of what?
consolidation.
Okay. Then the DOA is a date of acquisition.
Date of acquisition.
Date
Yes.
of acquisition.
Okay, sir. Thank you.
Welcome. Okay. Having done this, we are good to go. On note one, we don't really have any additional information to work on because they've given us the purchase price and we don't have any issue. And just like I told you, if you look at the SOFP, you'll see that in the books of ABBA, they have investment of 33.5 million. How did they come about 33.5 million? They paid 20.5 million to acquire Suka. They paid 6.5 and 6.5 to acquire Zara. 6.5 plus 6.5 is 13, have you? Plus 20.5, that is what? 33.5. That is what makes up their investment. Are we getting it? Now, as you can see, they did not tell us that the purchase consideration is yet to be recorded. They've recorded it. We don't need to bother ourselves. They've recorded it. But if they now told us that it is yet to be recorded, that's when we'll now need to do the double entry for the recording. Does it make sense to us? Does it make sense?
Yes, sir.
Yes.
Yes, sir. Yes, sir.
Okay. Having said that, we don't have additional information too. There would have been workings for us, but we haven't done net asset summary. So we'll leave that also. Additional information 3, we have inventory that was bought from a member of the group. Once you buy inventory from member of the group, it's by calling it inventory at the end of the year, it simply means they are yet to sell those goods to a third party. But from the information given to us here, the seller made 30% profit on it. Now, because that goods is still within the group, because those goods is still within the group, the profit the seller thought they have made would recognize it because IS2 asks us to measure inventory at lower of cost and net realizable value. And what will be cost to the group now will be whatever cost the seller got those goods, not the cost the buyer acquires it. But if the buyer has been able to sell to a third party, then they don't have issue. There will be no issue of them what? There will be no issue of the seller. There will be no issue of the seller recognizing the profit. So what do? We'll say unrealized profits, URP, on inventory. So which one do we want to look at first? Let's take it one after the other. Zara. It is ABBA that is selling to both of them. So we'll say Abba to Zara. Abba to Zara will be what? Abba to Zara will be Abba to Zara will be, they sold the inventory they have left is 5.2 million. So I'll quote it in thousands. Let me just put it. All figures are quoted in thousands. So that means I'll be taking out the last 3 zeros. So that's why I'll write it as 5,200 multiplied by what? Since the profit they make is 30% on cost, and when profit is expressed as a percentage of cost, we call that a markup. But we don't know how much they bought it, but we know how much they sold it to the buyer, because what Zara would have recorded in their home books is the price at which they buy from Abba. So that price they buy from Abba is selling price to Abba, but cost price to Zara. So since Abba's profit is based on cost, we have to convert, and we don't know what cost is, we have to convert that markup to margin. And how do we convert markup to margin? Since markup is cost, since markup is profit divided by cost, then to convert it to margin, it will be what? Profit divided by cost plus profit. You know, when we do cost plus profit, it gives us selling price. Is that not it? So since profit over cost is 30 over 100, when we
Yes,
then
sir,
add that 30 back to the cost, it makes it what? Profit over sales. That's 30 over 130. So 30 over 130 times 5,200 will give us how much? That will give us how much?
1,002.
Please, let's get
1,000.
our calculators closer
1,002.
to us. 1,002. And how do we treat it? Because that 1,002 will make us overstate our inventory, we'll debit it to where? We'll debit it to retained earnings of Abba. Because Abba is the one selling, it would have been the one to recognize the profit. And we are saying, since the goods is here to be sold, the goods is still inventory to the entire group. So Abba should not recognize that portion of profit. So we'll debit it to retained earnings to reduce it back from the retained earnings of Abba, and we'll credit it to where? We'll credit it to the inventory. We'll credit it to the consolidated inventory so that we reduce the inventory amount to the cost price. Then we still have Abba to Zuka. Abba to Suka is what? Abba to Suka, they had 3,900 left. And since it's still the same 30%, it will be 30 over 130. And that will give us how much? That would give us how much?
900.
900.
900, yes.
So what do we do? Still, Abba is the seller. So we'll debit it to retained earnings of Abba to correct their profit and credit what? Inventory. We are done with notes. So we can also say intra-group sales. Intra-group sales. Like we said, we have to derecognize it because we are consolidating. So what do? The one Abba sold to Zara is what? 8 million. So the 8 million will debit it to the sales and will credit it to where? Cost of sales. We are derecognizing it from SOPL. Then the one Abba sold to Zuka, 6 million, will debit it to sales and credit it to where? Cost of sales. Is it clear?
Yes.
Is it clear?
Yes.
Yes.
Okay. We move to the next one, note 3. Note 3. So we were told that I've told us that the proposed dividend, we are not accounting for it. For the impairment test, we don't even know what the goodwill is before we can determine if there is impairment or not. We don't know because what they gave us is a recoverable amount of goodwill. So we'll come back to this. So having done that, we don't have any other adjustment. We'll now go to our usual group adjustment. And our usual group adjustment will start with what? The net asset summary. The net asset summary. So in order to not waste our time, we'll do both together, Suka and Zara. Suka and Zara. They will have DOA, DOC, PAE, DOA, DOC, PAE. So what are their equity items? As you can see, these are their equity items here. Share capital, ordinary share capital. For Suka, it is 10,000. So I'll come here and say 10,000. They did not tell us their share capital has changed. So what it is at the date of acquisition, still what it is at the date of consolidation. We leave it at that. PAE will be nil. For Zara, theirs is 15,000. Same as date of consolidation. Because don't forget, this statement of financial position is at the date of consolidation. But since they did not give us any alternative figure at the date of acquisition, we will assume it is still the same on both days. So for share premium, they don't have share premium, so there's no point bringing it there. But they had retained earnings. Retained earnings. So how much is their retained earnings? 37,000 at the date of consolidation. Don't forget, statement of financial position is at date of consolidation. 27,000 at the date of consolidation. But they gave us what the value is at the date of acquisition to be what? 7 million for Suka. 7 million for Suka. So if you put 7 million for Suka, I'll come and say 7 million. Then for Zara, it is what? They told us their retained earnings were standing at 3 million. 3 million. If that is the case, 37 million minus 7 million, that will be
30 million.
30,000. 27,000 minus 3,000, that will be what? 24,000. Then, do we have any other thing? No. The unrealized profit is not affecting the retained earnings of either of Suka or Zara. And even is affecting now, is affecting their net asset, but it's not affecting. So we leave it out. The only thing we have left is that for Zara, they told us that the fair value of their net asset was 24 million. Since they did not tell us anything for Suka, we'll assume that the book value is the same thing as the fair value. So we don't have issues with that. Now, if we had this one for Zara, it is 18,000. That's the fair value. That's the net asset at the date of acquisition. It's 18,000. But they told us the fair value is 24,000. And they now said anything should be taken as undervaluation of land. So we'll come here and say fair value adjustment. That means it's a surplus. Abi, it is not Suka that have it, but rather Zara. So how do we get the figure? 24 million minus 18 million will give us 6 million. 6 million. So since they told us the land is yet to be sold, the 6 million will still be remaining as at the date of consolidation, and that makes our post-acquisition nil. With that, we can now close each column. We can now close each column and get the summation. So this is 24,000 because that's what the fair value is. If you add it up and it's not giving you 24,000, then you've done the wrong thing. This will also be 24,000. It is just coincidence that this 24,000 and this 24,000 are the same figure. It doesn't have to be the same figure. Then this is 30. No, this is 42, 48, 48,000.
Sister, we are not seeing the screen. Oh.
It will be from your network. Can others see my screen? So please kindly log out and rejoin. It is from your network.
I can't see the screen.
Huh? What do you say?
I think just left. Probably she's going to call me back.
So I have a question.
Go on.
Sir, please, I don't know if you can recap on the fair value adjustment, how you approached on the 6,000. I still don't get it. The fair value adjustment surplus.
Okay. Ideally, we are to calculate the what's it called? We are to fair value our assets on the date of acquisition. That's the normal thing to do, because you don't want to acquire assets that are overvalued. If the value of the assets, the book value is more than what it should be, then you will be losing. And they too don't want their asset to be undervalued. They will be losing. Do you understand? Now, what do we do? What we'll do is
Hello, are you still
okay.
there?
Yeah, I'm here. So what
So I
we'll
see
do
here.
is normally, yes, I'm here. Normally, they will give us what the what's it called? They will give us what the fair value of the asset is on that day, what the fair value of the net asset is on that day. So in this case, in the case of Suka, they did not tell us what the fair value of the asset is on that day, and we cannot assume, we cannot do what? We cannot import it, or we cannot assume for it. So the best assumption we'll do is whatever the what's it called? Whatever the book value is what will be the what? Is what will be the fair value. No issue. But in the case of Zara, they told us that the fair value of their own asset is 24 million. But when we did our book value calculation, which is based on the net assets, OSC and retained earnings, is just 18 million. So the difference is a 6 million. And they have told us that if there is any undervaluation of any asset, it should be attributed to the land. Are you getting it? It should be what? Attributed to the land. Now, if it should be attributed to the land, if it should be attributed to the land, that means what they are trying to tell us is that the land value has gone higher than what they have in the books, but they haven't revalued the land. Now that we are consolidating, we have to do the revaluation for them. So when we take the difference between book value of 18,000 and fair value of 24,000, we realize that the undervaluation is 6,000. That is what we recognize as the fair value adjustment, which is a surplus. Is it clear?
Yes, sir. Yes, sir. Yes, sir. Thank you.
Okay. Having done this, after doing net asset summary, we proceed to calculating goodwill. Goodwill. Then in calculating goodwill, we have what? Suka and Zara. So how do we calculate goodwill? Purchase consideration. Just like we said, the purchase consideration for Suka is how much? 20,500. 20,500. Remember, we are quoting the figures in thousands, so it will be 20,500. Why that of Zara is how much? 13,000. 13,000, which is as a result of 6,005 plus 6,005. Is it clear? Then NCI. Since they did not tell us anything about fair value of any of the subsidiaries or the fair value of their NCI, we'll measure NCI at proportionate share. And what do I say proportionate share is this? Their percentage of holding. In Suka, NCI percentage of holding is just 20%. Remember, from our group structure, NCI percentage of holding is 20%. Multiplied by what is the value of the asset? 17,000. While in Zara, they hold what? NCI hold 40%. NCI holds 40%. Why the book value of why the value of the asset is what? 24,000. So 40% of 24,000 will be what? I think that's 9,006. Why 20% of 17,000 will be what? 3,004.
3,400. Yes.
Yeah. So having done that, we go to purchase consideration. Then we say less fair value of net assets. Fair value of net assets as at what date? At the date of acquisition. What's the fair value of net assets here? 17,000. Then fair value of net assets here, 24,000. 24,000. So if we less it now, we get our goodwill. So goodwill, this one should be what? 6,900.
Yes.
Yes, very correct.
Why this one? This is a negative figure. Negative of how much? I think 1,400.
1,400. Yes.
Now, because it is negative, we call that gain on bargain purchase. Gain on bargain purchase. So that's a negative figure. That one, we'll close it. We add it to our consolidated retainers. We don't have anything to do to it. But for this one that we have goodwill, remember they told us that the recoverable amount of goodwill is 5 million in 2016 and 4.5 million in 2019. So I'll say less impairment. How much is impairment? If the recoverable amount of the goodwill is 4.5 million at the end of the year, that means goodwill at date of consolidation is 4.5 million. Because the recoverable amount is what? The recoverable amount is lower than the carrying amount. So if the recoverable amount is lower than the carrying amount, we say we should use the recoverable amount. That's what impairment is all about. Now, how much is the impairment? The impairment will now be the goodwill initially was 69 minus the value now, which is 45. That will give us how much?
2,400.
2,400. Now, someone might be wondering, what's now the essence of this 5 million they gave us? This 2,2004 is the totality of the impairment that has occurred on goodwill from the date of acquisition to the date of consolidation. But what we'll be reporting in our statement of profit or loss is only what transpired during the year. Now, if goodwill was 5 million at the end of 2016, they did not give us at the end of 2017, so that means it still remain at the 5 million. They did not give us at the end of 2017, that means it still remain at the 5 million. At the end of 2018, it still remain at 5 million. But at the end of 2019, it has dropped to 4.5 million. That means goodwill impairment for the year will be what? Please, can you mute your mic? 5 million minus 4.5 million, and that will give us what? 500,000. And what do we do to this? This will debit it to where? We'll debit it to our admin expenses, and we'll credit it to where? We'll credit, ideally, we'll credit it to goodwill. But instead of crediting only this 500, once we credit,
Are you there? Hello? Can anybody hear me? Hello?
I barely hear you, sir. Network is so bad.
Can anybody hear me?
Oh,
Hello, sir. Can you hear me?
I don't think he's presently on board.
You can hear me now. Please confirm you can hear me now.
Yes, can hear you.
All right, thank you. I'm so sorry. Just like I said, I really did not notice that I've been logged out of the meeting. Something just took me back and I.
Hello, I can
Hello.
hear you.
Did you guys see
When you were consolidating
when
it,
I
no,
did statement of total of consolidated retained earnings to be 94,500, right?
yes,
Okay. If that is the case, I want to believe others can hear me also. They just chose not to talk. And
Yes, sir.
if there is anyone that has left this call, if you know them, kindly tell them that the class is back up. Okay, so having done all of that, yeah, we move to the next thing, which is to now start the consolidation process. So we started with consolidation of statement of profit or loss as requested in the requirement of the question. So I say in consolidating statement of profit or loss, we've already explained that consolidation is adding of line by line item. So if we are adding the line by line item in this revenue, we added the three figures, 125 plus 117 plus 82. But remember that in the additional information, we have information that they sold goods within the group. Abba sold to Suka and Zara of 8 million and 6 million respectively. And we have said that any intra-group sales, the group adjustment rule is that what? We recognize it. That's why we
eliminated.
are taking it out 8,000 and 6,000. And as you can see, it is still in line with the workings we did here, debit sales. When we are debiting an income account, it simply means we are deducting from the account. So that's that. We go to the next item, cost of sales, 65 plus 64 plus 42. But the same way we are eliminating the sales, we also eliminate the cost of sales. Because why those things are still to ABBA, it is cost of sales. It would have been
Exactly.
part of the cost of sales to Stuka and Zara. But that's not all. Even the unrealized profits would have affected Suka and Zara's cost of sales because they would have deducted closing inventory at that high price, which is inclusive of Abba's profit element. So they recognize that, we have said debit retained earnings here. Another way
Mm,
we can take it is debit cost of sales. Are we getting it? Anything going
yes,
to retained earnings means it affects our SOPL. And how this would have
yes,
affected our SOPL is an increase in our cost of sales. It's just like
yes,
saying we overcharged what our closing inventory should be.
yes.
Because our closing inventory for Zara now, it should have been 4,000 if we have taken it at cost. But they use 5,000 because they were using this it up
24. 125 plus 170
Yes, sir.
plus 82.
This should be 175, 100. I don't know if I'm right. Kindly confirm.
Oh, that's fine.
Okay, so that means gross profit will be 134,900. Abi?
135. Yes.
So we can then move to distribution costs. Distribution cost, no adjustment. So we'll say 21,000 plus 14,000 plus 16,000. Then admin expenses. Admin expenses is how much? 14,000 plus 8,000 plus 7,000. Then that's impairment that we calculated earlier, 500 for the year. This is where I will add it, plus 500. And that, so we'll have, I think that's all we have. That person can mute, please. I can hear myself back.
$51,000.
Okay. And the second one is what?
34,000. 34,000.
34 or 29?
Oh,
No, you know that these are expenses. If they are expenses, what is now our profit before tax? Okay, we have profit before taxation. And the profit before taxation will be what?
54,900. 54,900.
900 or 400? This is 500 here now. 500 minus 900 will give us 400. Then income tax expense, 10,000 plus 9,000 plus 5,000. That's 24,000. So we have what? Profit
3,400.
for the year. So we have what?
3,400.
30 as profit for the year. And once we get profits for the year, what do we do next? We do profits for the year attributable to owners of ABA, then NCI. Why we can easily do it this way is because all of the adjustment does not affect the profitability of the entities. So we'll just say the, the share of NCI will be in Suka, they only have 20%. So 20% of their own profit after tax, 22,000, plus here they have 40%. 40% of what? 40% of 12,000. Okay, so that is that. So that will give us how much? Okay, so if we add it all up, it will give us 9,002.
200.
And owners of ABA will take 30,400 minus
21,200.
9,002. So that will
21,200.
give us what? 20,000. No, 20.
21,200.
Is it 20 or 21?
Let's confirm it.
I don't know. This thing is not even responding properly.
I can't see the screen any longer. Okay.
So that's 21 what?
200, yeah.
200. Can you see it now?
Yes.
Okay, having done that, we can now go proceed to consolidation of statement of financial position. Consolidated statements of financial position as at 31 December 2019. So what do we have? So we have this. So what do we do? I would go to my statement of financial position. Non-current assets, what do we have? PPE. Hello, can you hear me? Hello, can you hear
Yes, sir.
me?
Yes, sir.
Okay, welcome back. Sorry for where the network is acting up. 5 PPE. What else do we have? We go to our current assets. What do we have in our current assets? So the investment will not be coming because in place of that investment, we are consolidating. Are we getting it? Instead of we recognizing our investment in the subsidiary, we are consolidating. So investment will not be coming to our, except if the investment they have is different from the purchase consideration they paid to acquire their interest in subsidiary. Let's assume their investment is 35,000 now. When we add up what they paid as purchase consideration is 33,500. The difference of 1,500 would have, but since this investment and the purchase consideration is the same, then nothing will be shown here for investment. So we go to the next one, cash at bank, and in hand. How much? 9,500 plus 2,000, and that will give us what? 15,500. Next we have is the trade receivables, and our trade receivables is how much? 20,000 plus 8,000 plus 17,000. That's then inventory. 30,000 plus 18,000 plus 18,000. That's 3666. Oh, sorry. For the inventory, we have unrealized profit. So we need to take care of the unrealized profit, which is 1,002,900. So if we take that out, that's 2001. 2001. That will be 63,900. 63,900. So we have what? 60. We have 63,900. Aside that, I don't think we have any other value. We can take summation of all this, and that will give us what? Hello, are you guys following me?
Yeah.
Yes, sir.
I'm with you.
Yes, sir.
Okay, so we can move ahead to equity. So we get to equity. What will be our equity? Share capital, no need for adjustment. They've already recorded whatever difference we have there. But please, equity items, we are recognizing that of parents only. So equity will be share capital of parents only. Share premium, 6,500. Then consolidated retained earnings. Consolidated retained earnings, we have what? 94,500. So that will give us what? 141,000 as shareholder value. NCI. What's our NCI? These are workings here 94 and 19.2. 94, 19.2. 9,004 plus 19,200. And that will be what? 9.4 plus 19.2. 28,600. After NCI, then we bring other liabilities. Current liabilities. So current liabilities is what? 23,500 plus 6,000 plus 17,000. $46,500. Okay. We have what? 216, 100. So something is wrong. Go. Ladies and gentlemen, what do we have? Hello?
Oh, it's you.
Yeah.
Oops. This unrealized profit, we should have deducted it too. The unrealized profit, we should have deducted it. You know, it's a reduction to their profit. So please let me correct that from your end. So this should have been 90,300. Unfortunately, this whole thing doesn't want to write this night. So if it is 90,300, so let's come back here. So once you change the consolidated retained earnings to 90,300, everything will be correct. But unfortunately, I can't write. I don't know if it is my writing pad or the material or anyone. I don't know which one is acting up amongst them. But as you can see, I've been trying to write, it's not working. So ladies and gentlemen, that is where we'll be calling it a time tonight. Thank you very much for joining. Um, we meet in the next class for another discussion on group accounts.
So please, I have an observation.
Go on.
Yeah, please, I would suggest probably should be dropping the notes before the class, probably like 2, 3 hours before the class, so we can actually have a printout or preview it before the class starts.